This is the second video that's looking at notes receivable, and particularly we're looking at Wacom Appliance and Furniture Supply, and now we're looking at 2B. So 2B is basically now a sale to a restaurant, and again, to keep things consistent, we have a sale of $30,000, and we're selling restaurant equipment that had an inventory value of $20,000. But in this case, to make sure the sale went through, because this is a very competitive industry, we offer them a 6-month note and with no interest. So they can pay us in 6 months' time and just pay us the $30,000. Okay? Now, typically these types of notes carry an 8% interest rate in the market. So I have to do a quick little computation here to start things off. Again, it's a $30,000 note at 8%. Annually, that would be $2,400. Make that a 4. It's outstanding for 6 months, 6 months over the 12. So that would be over the entire 12-month period, over the 6-month period. This is how much interest we would have collected if this had interest bearing on it. So we're going to record the note receivable of $30,000. Now you're going to see why I did this, because now we're going to record an account called discount on note receivable, and that's going to be a credit account. So this discount on note receivable is a contra account. It's a contra account to the note. It's a contra to the note receivable. So what happens is this account amortizes over the life of the note receivable, so that when we actually get paid, the discount on note receivable account will be 0. So what happens then is our sale price for this to go down, our sale price goes down to make this journal entry balance. So you can see by accepting a note receivable with no interest on it, the effect is that it affects the sales, because it's implicitly assumed that we have interest and that no rational company would actually ever finance something for free. They don't. It's giving away something away. So to secure this sale, they're giving away interest. So there's a discount on that note. So the sales price is adjusted. So that's the journal entry we would have made on September, on 9/1 when the sale happened. Okay. Now on December 31st, at the end of the year, we need to record some revenue. We have interest revenue on this note receivable. And how much is it? Well, if it's $1,200 for 6 months, divide that by the 6, that gives us, what, $200 a month? Multiply that by the 4, and that's $800. So you can see there is some parallelism with a note that has a stated interest, that the numbers are fairly similar. But now our credit is to discount. Oh, excuse me, I've messed this up. So this is, I've messed this up. I was thinking about the other one. This is going to be discount on note receivable is our debit, and interest revenue is our credit. So you can see we're starting to amortize this. So if we had our discount on our note, we started with $1,200 in that account. We've now debited it for $800, and there's $400 left in that account. So that's the amount of interest revenue we had recognized at the end of the year. Then on March 1st, when this thing is going to get paid, you can see now we're going to get cash of $30,000, which is the amount of the note, and the note receivable is going to go away of $30,000. The other thing that's going to happen is we're going to get rid of the discount on the note receivable. The remaining $400 is going to be debited, and we're going to record some more interest revenue of $400. So this is the journal entry then we make when it actually gets paid. So this is the video on how to do the journal entries on a non-interest bearing note.